Hi everyone, and I welcome all of you to this special video brought to you by International Tax Academy by Manoj Naudiyal. I am Manoj Naudiyal, and in this video I am going to walk you through Amount B of Pillar 1 of BEPS 2.0 project of OECD. This video, that is Amount B Pillar 1, is going to be based upon the Public Consultation Document which was released by OECD on 17th of July 2023. This document that I have in my hands, I'll just show that document to you. So this is the document. Yeah, so it's Pillar 1 Public Consultation Document, Pillar 1 Amount B, 17th of July 2023 till 1st of September 2023. Fine. So this was a public consultation document, and the public, the stakeholders, they were invited to make comments upon Amount B till 1st of September 2023. Now the comments have been received and OECD is working upon those comments, right? So in this video, I'm going to cover this would be the base document for this video, and I'm going to cover different sections in this video pertaining to this document. So I'll just give you a brief overview of what I'm going to cover, and then we'll move forward, right? Okay. Right, so amount B, so we'll start with the definition. What exactly is Amount B? Definition, what is Amount B? Some basic terms, objectives, sort of, right? Definition, objectives. Then I'll move over to the scoping part, scope of transactions covered by Amount B. Then we move over to the pricing part, pricing framework, and then we'll move over to the future work, and then implementation. So in this small video, yeah, it's going to be a small video, implementation, right? So in this small video, I hope to cover all these 1, 2, 3, 4, 5. Fine. Definition, objective, then scoping, scope of Amount B, pricing, how do you price the transactions, how would you price the transactions, future work, and then the implementation part. Fine. So definition, objectives. First, Amount B is an integral component of Pillar 1. Pillar 1 consists of Amount A and Amount B. Amount A is beyond arm's length principle, that has got nothing to do with the arm's length principle. It's a formulaic approach, 25 over 10 rule. However, Amount B is concerned with the application of the arm's length principle. Fine. And the objective of Amount B is to simplify. I repeat, objective of Amount B is to simplify and streamline the application of arm's length principle to in-country, in-scope, baseline marketing and distribution activities. I repeat, the objective of Amount B is to simplify and streamline the application of arm's length principle to in-country, in-scope, baseline marketing and distribution activities, so that the outcomes are consistent with the arm's length principle. Simultaneously, Amount B also aims at giving special consideration to the concerns of low capacity jurisdictions, especially the concerns wherein LCJs, that is low capacity jurisdictions, they face difficulty in obtaining reliable local market comparables. Right. So this is the objective of Amount B, that is concerned with the application of arm's length principle to simplify and streamline the application of arm's length principle to in-country, in-scope, baseline marketing and distribution activities, while giving special consideration to the concerns of LCJs, low capacity jurisdictions. Fine. Now, why baseline marketing and distribution activities are important? Why? Because the low capacity jurisdictions have voiced their concern that TP disputes in LCJs 30 to 70% of the TP disputes in LCJs, they pertain to marketing and distribution activities. So it becomes amount B in that sense of the term becomes very, very important for your low capacity jurisdictions. And in this case, amount B, if implemented, I mean, this is what OECD says, that it would enhance tax certainty, it would avoid and minimize TP disputes, it would enhance tax certainty, and it would reduce the compliance burden as well as the administration costs. Fine. So these are the objectives of amount B, that it's a traditional TP. I repeat, amount A beyond arm's length principle, but yes, amount B very much the application of the traditional arm's length principle based TP. Fine. So definition and objective, these are the definitions and definition and objective of amount B, right? Coming to the second part, scope. Now, amount B objective is to simplify and streamline the application of arm's length principle to baseline marketing and distribution activities. I would like to focus upon certain words. B, baseline marketing and distribution activities. B, baseline. So when you talk about baseline, what do you mean by baseline? So amount B would specifically focus upon those transactions. Only those transactions would be within the scope of amount B, which are the baseline transactions. What do you mean by baseline transactions? Those transactions which do not make use of, which do not involve unique and high value intangibles. So no unique and high value intangibles, no unique and high value intangibles, plus they should also not involve any economically significant risk. So no involvement of any economically significant risk. So this is very clear. I mean, only those transactions, only those baseline, only those marketing and distribution activities or transactions would be in scope which are baseline, and for a transaction to be termed as a baseline transaction, no involvement of unique and high value intangibles and no economically significant risk. Very, very important, baseline. Fine. Then distribution. When you talk about distribution involves wholesale marketing and distribution activities. So wholesale distribution, and distribution also includes sales agency transactions, as well as commissioner transactions. So commissioner. Fine. So distribution transactions including wholesale distribution, sales agency transactions, and commissioner transactions. When you talk about wholesale distribution means distribution to any customer except the end customer. Distribution to any customer except the end customer. That is not the retail distribution. However, a certain de minimis retail sales, a certain de minimis retail sales is also permitted, where in the sales activity carried out by the entity, that is the distributing entity, the retail sales is less than 20% of the annual net sales. 20% of annual net sales. Fine. So when the retail sales of the entity is less than 20% of the annual net sales, okay, 20% of the annual net sales, okay, less than annual net sales. So when the retail sales of the entity is less than 20% of the annual net sales, then the entire activity of that entity is supposed to be a wholesale distribution activity. Fine. So this de minimis sales is also taken care of. Right. So baseline, distribution, and wholesale. Now the scoping transaction, I mean the scoping criteria is further elaborated in paragraph number 8. of this document that I just now showed to you. Fine. So that document, okay, that document in paragraph 8 gives you two criteria for scoping. It says scoping, right? So scoping transactions, scoping criteria in paragraph 8, scoping criteria in paragraph 8, paragraph 8, the first criteria is the transaction should have such economically relevant characteristics. The baseline marketing and distribution transaction should have such economically relevant characteristics so that it can be priced using a one-sided TP method. One-sided TP method, that is one-sided TP method should be applicable. What are the one-sided TP methods? Cost plus, resale price and TNMM. So the baseline marketing and distribution activity in scope should be such that the economically relevant characteristics make it amenable to the pricing by one-sided TP method. Fine. As well as second criteria is a quantitative filter. It's a quantitative filter which says that the annual operating expenses should be more than 3% but less than 30% or 50% of annual sales. Fine. Just let me confirm this, but I think yes, this is the case. Perfect. So annual operating expenses should be more than 3%, but then less than 30% to 50% of the annual sales. So this is the quantitative filter. So paragraph 8 mentions these two criteria as a scoping criteria. So for those transactions which fulfill this scoping criteria, they will be in scope for this in scope of amount B, that is simplified and streamlined approach, right? In paragraph 9, immediately after this paragraph, para 9 mentions exclusions. So there are certain, in spite of a transaction coming in scope, that is in spite of a transaction fulfilling the criteria in paragraph 8, if they fulfill the criteria of paragraph 9, then they will be excluded. What are the exclusions? First exclusion is that if the entity involved makes non-baseline contributions. Remember, amount B is applicable for baseline marketing and distribution activities. So if there is an entity, the tested party, if there is, yes, and the entity which is carrying out the baseline marketing and distribution activity, that should be the tested party. Fine. So the entity, that tested party upon which you are going to apply the one-sided TP method, if that entity carries out non-baseline contribution, if that entity makes non-baseline contributions, then the transaction will be out of scope of amount B. Fine. So non-baseline contributions excluded. Second, distribution of services and trading, distribution and marketing of commodities, that is commodities transactions and distribution of services, they are outside of the scope of amount B. So services as well as commodities, they are out of the scope. Services as well as commodities are out of scope of amount B. And the third criteria, exclusions, deals with when you have a non-distribution activity. Fine. So where you have a non-distribution activity, if you are able to segregate the baseline marketing and distribution activity, it is fine. But if you have a non-distribution activity and you are not able to segregate that, then in spite of the baseline activity being in scope, the entire transaction will become out of scope. So it will be excluded from the application of amount B. Fine. So scoping criteria in paragraph 8, these two criteria, one-sided TP method should be applicable, and the entity, that is the entity that is commissioner or sales agent or wholesale distributor, that entity should be the tested party. And the second, that is the quantitative criteria, that should also be fulfilled, that annual operating expenses should be between 3% and 30% or 50% of the annual sales. So these are the scoping criteria. Exclusion, non-baseline contributions out of scope, distribution of services and commodities out of scope, and non-distribution and non-distribution activities, they are also out of scope. Fine. Okay, scoping done. Come to pricing. Okay, yes. So pricing, what does the document propose? So it is already mentioned that the document, the scoping criteria says that one-sided TP method will be applicable. So the relevant one-sided TP method which has been chosen is TNMM. So TNMM has been chosen as the preferred method. TNMM has been chosen as the appropriate method for the pricing of baseline marketing and distribution, that is for amount B. And why? Because TNMM is less affected by transactional differences compared to CUP, or as well as TNMM is more tolerant to any functional differences compared to cost plus method as well as your resale price method. Fine. As well as tested party does not make any unique and high value contributions, that is no unique and high value intangibles, as well as no economically significant risk. So TNMM has been chosen as the preferred method. However, there is a proviso that if the taxpayer can get hold of a comparable, taxpayer can get hold of an internal comparable, then it can make use of CUP method. So you can apply CUP provided you are able to get a suitable internal comparable. In that case, you can apply CUP. Although OECD says that this will be quite rare. Why? Because commodities transactions have already been taken away. They have been excluded. Fine. So TNMM is the preferred criteria, preferred method. How do you apply TNMM? Now the interesting part is that pricing. Okay. Pricing is based upon pricing. There is a pricing matrix. Pricing matrix. So 1, 2, right? Fine. This is a pricing matrix. It's a safe harbor sort of, right? Safe harbor. It's a pricing matrix that has cells. Herein you have industry groupings, group 1, group 2 and group 3, right? And in the rows you have factor intensity, high, low. Fine. Industry grouping, group 1, group 2, group 3, and factor intensity from high and low. Okay. Pricing matrix, there'll be entries. For example, here you have what, 3.5% plus minus 0.5%. Okay, 1, 2, 3. Here you have 3.25 plus minus 0.5%. They are percent, right? Percent. And here you have 2.25% plus minus 0.5%. Here you have 5.5% plus minus 0.5%. And here you have 1.5% plus minus 0.5%. And then there are other entries as well. These 3.5 plus minus 0.5%, 3.25, 1.5, these These entries, they are percentage return on sales. They are return on sales in percentage. Return on sales. Return on sales. Return on sales. Determined on the basis of application of TNMM on a global data set. What do you mean by global data set? Global data set is a comparable which has been derived, which has been searched on the basis of global search on a commercial database using financial indicators for the companies. Fine. And it is known as global data set because the geographical filters have not been applied. Global. Remember, LCJs, they face a difficulty in getting suitable local market comparables. So that is why OECD is trying to achieve the result that even if you are not able to get suitable local market comparables, then also you should be able to apply amount B. Fine. So geographical filters have not yet been applied. Return on sales. Fine. So these entries, they indicate return on sales. Industry grouping. Grouping has been made. You find annexure B. Annexure B, you find grouping of industry, group 1 industry, which show group 1 industries are those industries which show a statistically significant relationship between with low returns on baseline activities, baseline marketing and distribution activities. Group 2 industries are those industries which are neutral, which do not show any statistical relationship between the returns on baseline marketing and distribution activities. And group 3 industries are those industries which show a high statistically significant relationship between the baseline marketing and distribution activities and the profitability. So on a very general level, group 1 industries are those industries, agriculture industries, perishable industries, perishable in the sense perishable food items, etc. Those industries. Group 2, IT industry, information technology, right? And group 3 industry, pharma companies, specialized industrial equipment. Fine. So this is the grouping of the industry, that is vertical columns. Factor intensity, two factors are taken. One is operating asset intensity, operating asset to sales, it's a ratio, operating assets to sales, and the second is operating expenses intensity, operating expenses to sales. Now, how do you make use of this pricing matrix? What do you have to do? First of all, you have to choose which grouping in the industry, your industry lies in which of the groups, group 1, group 2, group 3. Fine. Once you, supposing you pick group 2, group 2 is the industry, IT industry, group 2. Fine. So you have this vertical column. Now after you choose this vertical column, then you have to calculate these two factors, operating asset intensity and operating expenses intensity. Fine. How to high to low? There are numbers, percentages, ranges. So out of these 1, 2, 3, 4, 5 rows, when you calculate these two factors, you will, and this is not ratio, OAS and OES you have to calculate. So once you calculate these two factors, you will be able to locate which of these 5 rows suitable factor intensity will be applicable upon your industry. Supposing you pick this one. So now you have the row, you have the column. So it means for your case, the applicable return on sales will be equal to 3.25% plus minus 0.5%. Done. Job done. Now you have the pricing. This will be the return. This will be the return applicable. Fine. So you apply, this is the arm's length, this is the arm's length price. This is the pricing matrix which has been proposed in section 4. Fine. Okay. Now OECD further says that in some cases there might be some data, some jurisdictions have said, some countries have said that there are certain differences between the profitability of BMDAs and the geography, the country concerned. So for those countries, OECD is working on a modified pricing matrix that is proposed in the subsequent section, that is in figure 4.2. So that will be a future work. Fine. So this is the pricing part. TNMM, general method. This is on the basis of TNMM. Fine. Wherever you have CUP, suitable internal comparable, you can make use of that, but that will be very rare. Fine. So pricing matrix is the general thing. Okay, fine. Future work, amount B, future work. So in the near future, I told you that comments have been submitted to OECD. So comments have been submitted to OECD. and they have been received. So OECD says that in the coming months, in fact, in the coming months, OECD says that scoping criteria will be further refined. There is, I mean, the use of qualitative criteria, quantitative criteria. If you will make use of qualitative criteria, then there is an alternative B which would make use of qualitative criteria. And if no qualitative criteria is used for scoping transaction, then that is alternative A. So that is something which is a work in progress that remains to be finalized. This modified pricing matrix that I told you, that remains to be finalized. Then in addition to this, amount B, OECD is also exploring whether amount B can be applied to wholesale distribution of digital goods. Distribution of digital goods, OECD is exploring this as well. Fine. So this is the future work, near future, coming months. Fine. And OECD says that incorporating the comments that it has received plus the future work, all this will be incorporated in the final report that is expected to be released by the year end, that is 2023 December, and that final report will be incorporated in the OECD transfer pricing guidelines. That final report will be incorporated in the OECD transfer pricing guidelines, and that is supposed to be done by coming January, that is January 2024. So by January 2024 end, you can expect a new version of OECD TP guidelines which would include the amount B, the simplified and streamlined approach for application of arm's length principle to your baseline marketing and distribution activities. Fine. So this is a very quick, short summary, just bird's eye view of this document, Pill 11 Amount B, which has been released by OECD on 17th of July 2023. Prior to this, also OECD had released a document in December 2022. This is second document, and there can be a final report as well. There would be a final report shortly in next 1 or 2 months. Fine. So I hope you enjoyed this video, and do share this video with your network. Comments would be welcome, and do subscribe to the channel. Thank you so much for your time, and hope to see you soon. Thank you so much. Bye. Take care.